So yesterday we noticed a kind of bullish trading at the fixed income segment of the market. That's the treasury bills and the bonds market. Let's talk to Associate Vice President, FMDQ OTC Securities, Jumoke Olaniyo, who is also the head of market development and regulation division at FMDQ OTC. Good morning to you, Jumoke. Thank you for joining me.
Good morning.
It's great to have you on the program, Jumoke. Looking bright and beautiful on a good Thursday morning. Now, what has been the effect of the recent MPC decisions on the markets? We noticed that the monetary policy rates were retained, and then the revision of the forex market framework. What effect has it had on the market?
Well, you will notice that before the MPC, inflation had been on the rise, and of course, at the last MPC meeting, the central bank increased the MPR rate in reaction to that. So what we saw in the fixed income market is a lot of investors had positioned expecting that the MPC rate was going to be further raised because inflation had continued to be on the rise as well. So a lot of investors had taken short positions in the market. But with the retainment of all the indices or all the factors on the from the MPC meeting, it's been a reversal in the fixed income market. And so pension fund administrators and those other investors had sort of offloaded or tried to diffuse the short positions they've had. And so they've been buying back in the fixed income market. And as a result of that is why we've seen a lot of the activity we saw in the fixed income market.
So talk to us a little bit about how these decisions also impacted other asset classes, particularly the forex market.
Well, I guess there's a lot of expectation still in the foreign exchange market. We don't have much details yet with regards to what the flexible foreign exchange management framework is going to be. But if you ask me what I would say, I guess there's a lot of anticipation as to whether the currency is going to be floated fully or whether it's still going to be managed. And of course, there's a lot of expectation at what rate is the adjustment for this flexible foreign exchange market going to go to. Market is not yet up and active in foreign exchange market, but there's quite a bit of speculation going on, quite a bit of expectations in that market. Parallel market has reacted as it would in anticipation that there's going to be a little more flexibility in the interbank or the official market, but we haven't seen much movement in that line. And because there's not been much movement, of course, in the interbank market, there hasn't been much activity from foreign portfolio investors as well.
But then reports showed that bonds and treasury bills yields have been contracting on increasing demands within the last few days. Any indications of the source of demand?
Absolutely, and this was just regards to the first point I talked about. A lot of pension funds, a lot of institutional investors had taken short positions in anticipation of MPR rate going up, but with the retention of the MPR rate, they've now reversed their positions and had to buy back, to close out the short positions they had, and that is what has been the activities and the effect in the fixed income market.
But then what class of investors are taking advantage of these opportunities?
I would say pension funds have a lot of, the volumes would primarily come from pension funds, but I will not discount the amount of volumes that would have come from the dealing member banks, because they also push a lot of volumes in the fixed income market.
So on the back of the new FX market framework, what issues do you think need to be addressed to attract significant dollar supply to the interbank forex market and ultimately the fixed income market?
So I think there's still a bit of ways to go. Even if the flexible foreign exchange management framework is released today, I don't see foreign portfolio investors coming back immediately. I think there are quite a few things that would need to be sorted out, or there are a bit of things that they would like to see addressed in our market before they come back. I think what is primary to them is price transparency and price formation. To be able to see that there's a market where demand and supply is the one that determines what the foreign exchange rate would be. A free market without a cap, a free market where they can access whatever amount of foreign exchange they need, should they need to repatriate their funds out. So I think that would be top on their list, that the market is governed and transparent will be very important for them. I think also, and you mentioned that in your question, that if foreign portfolios are coming back, they're not just coming back to sit in the foreign exchange market. They're going to be investing in equities or investing in fixed income. For fixed income market, they would want to see yields that speaks to good returns for them. With the level of inflation we have today, addressing foreign exchange risk that they would experience, they would need to be seeing, say, any of yields of above, say, 15 to 16% and above, that would make it attractive enough for them to want to come back into the Nigerian foreign fixed income market. So the yields in our money market as well would be a major factor for them in coming back in. I think also from what we've experienced within the last 18 months, they'll be very concerned and very interested to see that we have hedging instruments and hedging opportunities in our markets. I don't think any of them want to be caught up in foreign exchange volatility like they experienced before. So they would want to know that they have opportunities to be able to hedge if they need, when they come into our financial market. I think also one thing that would be important for that market to attract supply would be for us to minimize the dominance of our power market today. We need to reduce the opaqueness in that market, and we really need to infuse a lot of governance in that market. So we need to be thinking of how to organize an alternative FX market. I don't think it can be done away with in total, but infusing governance and transparency further into that market, bringing some form of alternative market, alternative FX market that has all of that backing it up, will further support the kind of stability we want to see in our official window.
But then, Jumoke, sorry to cut you here, but if there's an alternative forex market introduced, don't you think that there'll be more round tripping and we'll continue to see a further increase between the official and the other autonomous sources where dollar is sourced from?
But that's what the governance would speak to. The governance would speak to what is allowable in an alternative FX market and what should be handled in the official market. The governance will also speak to what you need to provide in the alternative FX market that would, infuse that transparency. And transparency deals a lot with a lot of round tripping. It will address a lot of the round tripping that we see there. Documentation requirements, minimum amounts that you can access through that alternative FX market. So that governance I was speaking about would be addressing those shortfalls or those shortcomings that we see in the power market today. Because there are some legitimate transactions in that market. So it will all be about keeping those legitimate transactions in the market and making sure they have an organized market where they can continue to transact and access their foreign exchange.
Jumoke, thank you so much for your time this morning.
Thank you very much.
Jumoke Olanio is the Associate Vice President, FMDQ OTC Securities Exchange, and she's also the Divisional Head of Market Development and Regulation Division, giving us perspectives there on with regards how investors will be reacting in the fixed income segment of the market. A lot of conversation continues around that. Join us on Twitter, or you can send us an email to businessmorning@channelstv.com. The conversation continues in just a moment. We're talking about the energy markets and, of course, domestic commodities after now. Stay with us.